Let's take a look at a simple representation of the operating and financing aspects of a business. As we have seen, the capital is vital and generally comes from two sources: from shareholders who provide equity and from banks who provide debt. The managers of a business invest the capital in the fixed and current assets needed to run the business, such as furniture, equipment, vehicles, inventory, and so on. The capital and assets, as shown here, are a simplified representation of the balance sheet, with the assets on one side being equal to the capital borrowed from the shareholders, the equity, and from the banks, the liabilities, on the other side. Using the assets, the business generates profits. Financing costs, such as interest payments on loans and dividend payments to shareholders, are deducted from the after-tax profits to leave retained profit. The profits and financing costs, as shown here, are a simplified representation of the income statement. The amount left after all the operating and financing costs have been deducted is the retained profit. This retained profit provides the link between the income statement and the balance sheet. It is added to the capital that was initially provided to start the business to help fund future growth. The left-hand side of this diagram represents the operating aspect of the business. The right-hand side represents the financing aspect of the business. Separating the operating and financing aspects of the business encourages operating managers to focus on the most effective utilization of the operating assets under their control.